we're going to add a spouse to Justin's baseline projections. I just need to click the Add Spouse button, and Julie is Justin's wife. She's a couple years younger than Justin. And so as we continue on to the general page, we'll see that Snap is automatically having her retirement age the same year that Justin retires, and it's ending her projections in the same year that Justin's end. This is the easiest situation where we don't have to worry about a rollover of assets. Under expenses, we can update to $96,000 for the combined expenses, and we'll also add a travel expense. So this will be $10,000 a year, and it is a joint expense that will start from the beginning of the projections and go until Julie's age 73 every year, and we will highlight that in our cash outflows chart. Notice that I'm right now on Julie's page. I have this button for Justin and a button for Julie, and I can see Julie's name in the header as well. Under incomes, we can add her employment income of $80,000 a year. And it will be indexed, so I click delete to remove the value here, and it will automatically go to general inflation, starting from the first year and ending when she's 62 years old. She also has a defined benefit pension plan that starts at age 63 for $45,000 with an 80% survivor benefit that drops down to $38,000 a year once the bridge benefit is gone. Under assets, we can take a shortcut. So for Justin, we had his assets, and if Julie has similar ones, we can use the action to copy this asset to the spouse, and then we can just make updates on Julie's page afterwards. The non-registered account can be selected that it is a joint account, and the same for the house. That will split these assets 50-50 between both spouses. So now I can go to Julie's financial assets. I'm going to delete this default asset and update her RSP to $100,000. And note that we can also choose spousal RSPs now that we have a spouse in the plan. Along the top, I can adjust Julie's TFSA room, RSP room, perhaps add a pension adjustment, and we can also base the minimum RIF withdrawals on the age of the younger spouse. Okay, so let's continue on to the debts. The mortgage has already been specified as joint because we had linked it to the house. And the government benefits have started for Julie at 63 because that's her retirement age. We'll select 65 and keep the national average. Note that there's a survivor pension that can be included if Julie were to pass away earlier than Justin in the projections. All right, so take a look at the planning pages now. We have an additional couple of pages. So we have a combined page for the couple, has mostly summary information. We have Justin's page and Julie's page. I'm going to go to Julie's page now so that I can enter her RSP and TFSA contributions. So $3,000 to her RSP and $7,000 to her TFSA. I'm making these overrides again and then running the scenario. Once she has available pension money that could be split, we can see under this transfers column that there's an automatic transfer of $4,600 from her defined benefit pension. It's removing that much from her taxable income. And if I check Justin's page, it's adding that to his taxable income. We can see under the base expenses that each of them have a portion of the $96,000 amount that they're spending as a couple. So looking at the combined page, we can again see that $96,000 that we'd entered under the scenario setup has been placed for us here at retirement when the CFM age starts, the start age. And now the $96,000 goes every single year, split between the couple. And at the end of the projections, I have an all types column, which shows they have $226,000 left. Or I can click that final year for the estate to see the values between the couple. So we have the total for them as a couple, and we have their individual amounts. If you have ended the projections for one spouse prior to the other, make sure you're looking at the longest living spouse in this table to have the final estate values in the latest year. We also have our additional travel expense that goes through here. And if I go to the charts, I can see that is highlighted in the chart. So here's my travel expense that ends at age 73 for Julie. One thing to point out on this combined page is that you can expand the sections to see individual information. So we have Justin's employment income and we have Julie's employment income. Or if it's a collapsed view, we have their total employment income. Where this is really helpful is, for example, with taxes. If I expand that section, I get the headers that let me to get more details for the total taxes and taxable income. And for financial assets, if I expand this, I can see their individual contributions. If I collapse it, I can see the total values of all the different types of accounts and an all types account with total contributions and withdrawals for the year. Next, let's take a look at the client report. When you have a couple, there are going to be more pages that are available. So for example, cash inflow details is available as a summary for the couple, but also we have a page for both Justin and Julie. If your clients are not so analytical that they would need to have all of these pages, you can come back to the report builder and select the pages that you'd like to exclude. For example, this cash inflow. For both of them, I just drag it out. I have the cash flow projection as well that has for both of them, drag it away. Another way that you could choose which pages to include would be to disable the included pages and then go to the report editor and take a look at your pages here and decide using this checkbox whether you'd like to include or exclude them. Once you've deselected the ones you don't want, then you can go back to the report builder, enable the included pages, and reorder the pages just by dragging and dropping them. And this concludes what you need to know about adding a spouse to your projections.